We're going to talk more about taxes today, more so just kind of basics of taxes. But for like future webinars or past webinars or anything, the best way to access those are right on our website. So we're going to post this on our website. But if you haven't gone and taken a look at our website and looked at all like the videos and past webinars we've done, I definitely encourage you to do that. So today, it's more so just kind of going through the basics of taxes. And I know a lot of people, probably just got back their tax return. And so we thought, hey, you know, a lot of people sometimes don't really know, okay, why do they have to pay taxes this year or vice versa? Why did they get a refund and not really kind of knowing how to read their tax return. So we felt like it's a good opportunity, good window, right after tax time to kind of go through some of those basics. So it's going to be more so, just kind of a 101 class that you would take maybe in college or high school. And I'll try to keep it as quick as possible. I'm probably going to go 20, 25 minutes, and then we'll open it up for 5, 10 minutes of Q&A at the end. So jumping right into things, what we're going to cover today. First and foremost, what taxes are and why we pay them, the different types of taxes out there, how the different tax brackets work as well, because honestly, there's a lot of confusion there. Same with deductions and credits. A lot of times I see people get these mixed up, so I want to go through that. Some tax saving strategies, key forms like tax forms, like understanding, okay, what should I expect each year when I go and file my taxes? What are the forms I need? And then, go through some common misconceptions and questions that I see. So that's the agenda today. But diving right into things, taxes, I'll be honest, no one really loves taxes, right? But they are kind of a necessary evil. And what I'm trying to get at here is, look, taxes do a lot of good, and we get all of us on this call get a lot of benefits out of taxes. But what are they? It's just payments that we make to the government to help fund all these different public goods and services. And so you can see, a list of some things that I listed. This is not an all-encompassing list. And you focus sometimes on some of the bigger things like national defense, Medicare, Social Security. This one has been a big topic of interest recently, interest on national debt. But I think sometimes we fail to remember, there's a lot of small things that go on behind the scenes too. I mean, talk about keeping us safe, police, firefighters, libraries, postal service, education. Obviously, infrastructure is a big one. I'm big in the outdoors, so I made sure to add this one in here, the national parks and conservation efforts. There's all these little things that the government does that we reap the rewards out of. And so it makes sense that we would have to pay to have those benefits. Now, that's not me saying that we should pay more in taxes than we have to, right? And part of our job here is to help you guys pay as little in taxes in your lifetime as possible. But there's a big difference between tax minimization and tax evasion, right? And so I'm a firm believer that everyone should pay their fair share in taxes. But, again, no one particularly enjoys taxes. And I think part of the reason is because there's so many different types of taxes. It can sometimes feel like we're getting hit from like every different direction with taxes. So, the most common, obviously, you got your payroll tax or your income taxes, right? So any money that you earn from an employer, you got to pay taxes on that. And I'm going to talk a little bit about the tax brackets and how that works here in a second. But you're not just paying federal and state taxes on your income tax, you're also paying payroll taxes, which is what you contribute to Social Security and Medicare. So, as you're working, you are paying into those systems so you can get the benefits down the road. And this payroll tax, I also get some misconceptions here. And sometimes people don't realize that they have to pay them or that their employer sometimes pays half of them. So I wanted to get some clarity here. So essentially your payroll taxes, it's about 15.3% that goes to Social Security and Medicare. Most of the time, your employer is going to pay half and you're going to pay half. So you're on the hook for 7.65% of that tax. Now, if you're like a 1099 contractor or you're running your own business, This is where I can see, with small business owners, they forget, oh, I have to cover all of the payroll taxes for myself, and I don't have an employer that covers the other half. So, it's a big tax, and again, we have to pay that. There's really no escaping that. We also have to pay taxes on any investment income that we receive. So this can be from stocks and bonds. This can be from real estate, right? They call it capital gains tax. And I'm going to talk more about this in a minute. We have to pay, anytime we buy something, we pretty much have to pay taxes on it. So you pay sales tax, and then, when you buy a car, it's not only a one-time tax, but then you have to pay personal property taxes on that as long as you own that car, that property, whatever it is. And then you also have this one, estate gift tax. This one's not very common. If any of you were on my estate planning webinar, I told you probably about 99.9% of folks never pay any estate or gift taxes, but it is a tax out there that some folks need to be aware of. And then this is kind of the big topic right now. Tariffs, they are technically a tax on US citizens or the citizens of the government, but it's not like all these other taxes, where all these other taxes are kind of direct payments that you have to make. Tariffs are more indirect. So it's usually that, prices increase and you have to pay them kind of indirectly, but it is a tax and it goes to the federal government. So again, there's a lot of different ways that they can get you. And I think, part of the reason, again, not only because there are so many different taxes that you get hit with, but, sometimes it can feel like our money is going to waste, right? And there's a lot of inefficiencies within the government. So I totally understand that. It can frustrate me too at times. However, again, these tax benefits that we get, these are huge, and there's a reason why we have to have taxes to fund, our public goods and stuff. So, kind of moving on to the income taxes and the different tax brackets. So again, at a basic level, I think most people know and recognize that, hey, there's a tax bracket system in the US. So the more money we make, the higher our tax bracket can be, right? And it's a progressive system. But what a lot of people don't realize, and I would say over half the people I talk to, they think that in this client right here, you can see their income, they were in this 32% tax bracket. So most people think once they are in that 32% bracket, all of their income is taxed at 32. And that is not the case. It's a marginal system. So you're filling up each bracket and then you move to the next one. So the first 23,850 is taxed at 10%, right? And then the next 73,000 taxed at 12, the next 109, 22, so on and so forth. So this particular case, even though they fell into that 32% tax bracket, not all their taxes were paid at 32, right? And so their blended or average rate was probably 15 to 20% because it's a mix of 10, 12, 22, 24, 32. Okay. So again, that's something that, I can hear pretty frequently. Oh, I don't want to get pushed into a higher tax bracket because then all my money is going to get taxed at this higher rate. And that's not the case. And we have a very similar system, just different numbers for capital gains. So again, tax bracket system, there's a 0% capital gains bracket, there's a 15, and there's a 22. And your capital gains, again, this is any investment income that you're going to receive. So anytime let's say you buy a house, you bought it for 100,000, you sold it for 200,000. Well, there's a gain in there of $100,000 that you have to pay taxes on. Right? And most of the time, most people are going to fall into this 15% capital gains bracket. And what you'll notice is this 15% oftentimes is lower than these, right? So most of the time, your capital gains are going to be taxed at a lower rate than your wages. Now, you could argue, hey, that doesn't necessarily make sense, or I don't agree with that logic. But I think the reason that they primarily do that is because they want to spur investment into the economy and the stock market. And so you kind of get preferential treatment with capital gains. But again, it's marginal. So, the first 96,000 would be taxed at 0, and then the next bit would be taxed at 15 and then 20. Okay. So that's the tax bracket system. And again, I get a lot of confusion on these. And so I wanted to go through them and just kind of clarify how those work. Another thing, deductions versus credits. If you go back to 2018, when they passed the Tax Cut and Jobs Act, it really simplified a lot of people's returns, and it really kind of eliminated the ability for people to take itemized deductions. So most folks now are taking the standard deduction. Okay. And for 2025, that standard deduction is 15,000 per person.
Wow.
And if you're above 55, it's another 2,000 per person. And if you're blind, it goes up a little bit as well. But most of the time, you're going to see 15 to 17,000 per person. So, married couple, they roughly get a deduction of about $30,000 that they can take off of their income. So deductions work if, let's say they, have a married couple, they have $100,000 in income, and they have a $30,000 deduction for the standard deduction. That means that they're only going to tax 70,000 of that income, and then it's going to fall in these different brackets. So, the first 23 is going to go at 10, and so on and so forth. Right. So that's what they actually calculate your income on, or your tax on, not this number. Right. So deductions are really beneficial because they reduce what your taxable income is. However, tax credits are even more valuable because it's a calculation that happens after they calculate your tax liability. So again, let's say you had that $100,000 in income, you had your $30,000 deduction, then you had 70,000 in income. And they said, okay, well, based off of that, you owe $5,000 in federal taxes. Well, if you had a credit like one of these, like the child tax credit, education credit, EV, clean energy credits, right? What they'll do is they'll say, okay, let's say you have a $5,000 credit. They'll actually subtract that from your tax liability after it's calculated. So those are much more valuable than deductions because it's a dollar for dollar reduction in your liability itself. And in this case, you'd owe only, nothing in taxes versus if this was a $5,000 deduction, your income would go down by another 5,000 and you'd still owe money in taxes. So again, tax credit's much more valuable. And then there's a lot of confusion sometimes on refundable versus non-refundable tax credits. Essentially what that means is a refundable credit means you owe 5,000 and you had a credit, let's say now of 6,000, right? Well, then the government's going to say, hey, that's refundable. So we're going to give you the $1,000 back as a tax refund. If this was non-refundable and it was the same situation, the government's just going to say, okay, well, we're even. You had a non-refundable credit of 6,000, you owed us 5,000. So we're not going to give you that extra 1,000 back, but we are going to reduce your liability up to as much as you owed. So main story here, again, most people are taking the standard deduction now. And then, credits are much more valuable than deductions, but they're both very beneficial. Okay. Moving on, some common tax saving strategies when it comes to the investments that we help clients with all the time. Now, I did a whole separate webinar on a lot of these different things. So I'm actually going to plug that right now and say, if you have any questions on that, I don't have the time to go through these today, but these are super valuable resources that you can use tomorrow to help reduce and minimize, your tax liability. So that's on our website. I would highly encourage you go and listen and watch that because that was a pretty good webinar that we had last year. So I'm going to skip this just for the sake of time. And then, in terms of all the different forms, and this can also get very confusing because there's a lot of different forms and documents and things like that. To simplify it as much as possible, you really kind of have your three main forms right here. You have your W-2, which is the form that you get from your company every single year. So they'll give you the form. It'll show you, okay, how much did you make for the year? How much was withheld? And you use that when you go and file your return. You either give it to your CPA or you go through it and when you're filing it yourself. Your W-4 is the form that you fill out when you first start with a company to set up what withholding you want to set. So previously, this form was like the one where you can claim 0 or 1 or 2, depending on your level of dependence. They actually just updated this form last year to where it's a little bit actually more complicated to fill out, but that's the form that you use to be able to adjust your withholding. Okay. So if, let's say, you're not withholding enough with your employer or you're withholding too much and you want to adjust it for this year, you would have to fill out a new W-4. And then the 1099, that kind of covers everything else when it comes to any income that you received throughout the year. So your bank is going to send you a 1099 for any interest income you receive. Your investment custodian, Pershing, Schwab, whoever it is going to send you a 1099 for any distributions that you took from the investments or any dividends that you received. If you're doing any contracting work, you're going to get a 1099 from them. If you receive Social Security benefits, if you receive a pension benefit, if you have any RMDs, right? All of that is going to come in the form of the 1099. So each year, you're going to have to collect every 1099 and make sure that you have them all. And then they use those forms to file your actual tax return, which is called the 1040. So when we want to look at your tax return together, this is the form that we need. We need the full PDF copy of your 1040. Okay. And then, these other schedules in here, these are for, other situations, right? Let's say you're a business owner or, you have real estate or investment income. That's what they use. And those are the different schedules. But these schedules are forms that your tax accountant is really going to do for you. So you don't really have to worry about those. So those are the key forms to know. And then just kind of wrapping things up, some common questions, misconceptions I wanted to cover. First, is a tax refund good or bad? Most people really like and enjoy getting a tax refund. The bigger the better for most people. But what I honestly tell folks is you don't want a big tax refund and you also don't want a big tax liability. Right? Ideally, what you're doing is you're kind of making it even throughout the year. So when you go and you file in April, you don't receive a big lump sum, but you also don't have to pay a big lump sum. And the reason behind that is because first, if you're getting a big tax refund, essentially all that means is you're giving an interest-free loan to the government throughout the year. So let's say you're supposed to get $10,000 back on your taxes in April. Well, you pretty much just lended that government that $10,000 for the entire year. And the government's not going to be very nice. They're not going to say, oh, yeah, we're going to pay you the interest that we should pay you for that money. No. So although people enjoy getting that big tax refund and it's kind of like a forced savings, if you will, honestly, if you can, I would encourage not to go down that route. And then the same for a big tax liability, because the government isn't as kind with liabilities, because they will definitely charge you interest and penalties if you have a large liability come April and you didn't meet their criteria. So again, trying to kind of balance it. And that's when you can either talk to us, your CPA, about, okay, how do I fill out this W-4 to adjust my withholding so I don't have a big refund or liability when I go and file taxes. All right. What if I file late? What's the problem there? Honestly, as long as you file an extension, you're totally a-okay. They allow you to extend it up until October 15th, so you got 6 months of wiggle room. But that does not mean that you don't have to pay what your expected liability is in April. They still say, hey, if you owe us a lot of money, just because you file an extension does not mean that you can avoid paying taxes for another 6 months. So that's something that I try to remind folks is, again, just because you haven't filed your taxes does not mean that you don't have to pay come April 15th. And you want to, at the very least, file that extension, because if you don't file altogether or you just miss the date completely, the IRS is going to penalize you a lot more than if you just file the extension and wait to pay. So failure to file, higher penalty than failure to pay. So keep that in mind. And this is always a huge one. My bonus was taxed way too high. Yeah, I got my bonus. It was $20,000. I thought I was going to be rich, and I got the net pay, and it was only $9,000. So people think, oh man, the federal government took half of my bonus. That is not the case. What the IRS has kind of outlined and for companies to do is that bonuses are not taxed differently, but they are withheld differently. So when you get a bonus, your company has to withhold at a higher rate than your ordinary, salary and wages. Right? So a lot of times people will get hit with the bonus. It would be withheld at a higher rate. And they think that, oh, no, I didn't get that money or it was taxed higher. That's not the case. When they go in to file their taxes, they usually get a refund for that money because bonuses are taxed exactly the same way. So any additional income, if you're in this 22% bracket, would be taxed at 22, even if they withhold a higher rate. Okay. I already talked about, not wanting to get pushed in the tax bracket, so I'll skip that. The donations to charities, this is one I see very commonly. A lot of people, because maybe previously they were itemizing, they think all their charitable deductions and donations are saving them in taxes. If you're not itemizing or you're not doing a QCD, those charitable contributions really are not saving you anything in taxes. So keep that in mind. There are other strategies that you could employ, something like charitable bunching. So bunching your contributions in 1 year. But, one thing I'll say about this, not to say you shouldn't donate to charities, but keep in mind, are you getting the benefit that you think you're getting out of it? And then lastly, I don't need an accountant. This one, there's a good cohort of folks who absolutely don't need an accountant. It's pretty simple. You go TurboTax, it's easy, it's efficient. But as you get more complexity, I have seen countless times the benefit that an accountant can provide, right? And oftentimes that benefit or the tax savings that they get outweighs and is higher than their actual cost that they have to pay the accountant. So, I would encourage, if this is kind of over your head and you don't want to have to worry about it, working with an accountant or CPA is probably a good idea. We work, in conjunction with them. We don't file taxes here at our office, but honestly, sometimes it's really helpful to have, a CPA in the conversation as well that we can kind of bounce ideas off of. So, I'll say, if you haven't already introduced us to your CPA, we'd be more than happy to, have a conversation with them, figure out, okay, is there any other strategies that we can employ, any ideas that the CPA has, and vice versa. We do that all the time. So, the accountant, the CPA, it can be a big benefit. So that's kind of it. Again, it's just more so like the basics 101. In summary, we covered what taxes are, why we pay them, what the different types of taxes are. I focused a good amount of time here on how the different tax brackets work, because this one I think is a big one. Deductions versus credits. Got to remember credits more valuable than deductions. Some tax saving strategies, and again, I'll plug that webinar. If you want to learn more about those strategies that were in the slide, then please watch that webinar on our website. Common misconceptions, key tax forms to know. So that's about it. Again, I wanted to keep it quick, easy, simple. If you feel like, this is something that was helpful for you to kind of just refresh your memory and you think, someone else could benefit, please feel free to send the recording to anyone that you'd like, friends, family, kids. I think a lot of times people get confused on taxes, and it's totally normal. The tax code is super confusing. And, there's thousands and thousands of different rules and regulations. So, don't try to make sense of the tax code, but I do think it's important at a basic level just to kind of understand some of these key components and pieces of the tax code. So with that, I will open it up for questions. So first one, are we responsible for Social Security and Medicare taxes after retirement or is active retirement? That's a great question. So you are not responsible to pay in the Social Security and Medicare after you retire and are no longer earning wages. So that's really the only requirement. If you are working with a company and earning wages, you have to pay payroll taxes. But if you're retired part-time and you're doing some consulting, you do still have to pay into Social Security and Medicare.
Okay.
So,
That was kind of the key point of the questions. Like, so like I haven't officially retired, but I'm no longer, fully employed. So then
yeah.
yes, I would still have to. But then once I declare retirement, or is the act of declaring retirement really just withdrawing from Social Security?
No, so you can retire before you take Social Security. Really,
Mm,
the action is just when you go and you file your tax return. As long as you have zero in wages, the government's going to assume that you're retired and you don't have to pay any Social
okay.
Security or payroll benefits. Yeah.
Okay.
And great question. And the other one, dividends, those are taxed differently. And I went more into detail on the last webinar on that. But your qualified dividends, which essentially just means that those are US based companies. So, they kind of give you a tax break and they say that those qualified dividends are taxed at capital gains, which are 15% for the most part versus non-qualified dividends. Those are taxed at ordinary income rates, and those are usually foreign companies, right? So companies
Okay.
outside of the US. The US says, hey, we're not going to give you a tax break on those dividends. So those are ordinary dividends, and they're taxed under this structure. And then state taxes, yes, charitable contributions can be included as a deduction on state taxes. But again, the state also has itemized versus standard deduction. So
Okay.
it kind of works the same way. Their structure is a bit different here in the state of Virginia. But if you have charitable contributions in excess of what that standard deduction is for Virginia, then yes, you would save in state taxes. All right. Um, I got to show a couple disclosures here. What else? Any other questions?
Cooper, if I had to pay a decent tax bill for 2024, should I go to the IRS website to do quarterly vouchers to avoid future, I guess, fines, you want to call them?
Yeah, so there's two ways to do it. One of it is to do quarterly payments, and that's pretty common. And it really depends on what is causing that tax liability at the end of the year. So if it's mainly caused from your investment income or other income pieces, then yes, I would encourage going through quarterly payments and making those payments accordingly. However, if it's just that your income, like your salary that you're earning, is not being withheld enough, then what I would do is I would actually fill out a new W-4 and adjust your withholding on your salary and any bonuses so that it's more levelized throughout the year. And then you don't have to worry about making quarterly payments and going on the website and all of that. So this is honestly the easier way to go, but sometimes, the driver of that extra tax is like investments and you can't withhold from the investments. And so you have to make those quarterly payments. But if the big driver is that it's a salary and bonus that you're just not withholding enough on, then I would highly encourage the W-4. And Sal, I can definitely take a look at that. I know we just asked, to go through your tax return with Rebecca. So that can be a topic that we go through as well together.
Awesome, that'd be helpful.
Yeah.
Another question. So my income is mainly W-2, but my wife's is mostly 1099. So we've gotten advice from our CPA about I should be withholding zero to increase the amount of payroll taxes to kind of offset our tax burden at the end of the year. So like where we don't have to pay estimated taxes. Is that
Yeah.
wise, or is it, basically to spread it out differently?
Yeah, no, it's a very common strategy to take. However, it can get tricky because you're relying on your income, right, for your monthly cash flow. And
Hmm.
so if you have a bunch of investment income and you're not sure exactly what the tax liability is, it's kind of hard to adjust your withholding to know exactly how much you should withhold, one, and then two, if it's too much withholding, then monthly on a monthly basis, you have a lot less coming in, and it's harder to kind of manage the bills on a monthly basis. So that's why, and Rod, I know in your particular situation, there's a good amount of investment income coming in that is not being withheld on. And so honestly, my suggestion would be is to probably make the quarterly payments from the investments so that your salary isn't really compromised, right? Because I think you can get into a situation where you're earning a good salary and you're living off of it, and then you have to adjust your withholding significantly, and then each month you're feeling tight and it's uncomfortable, and those investments should be covering what the taxes that they create. If I'm being honest. Great questions. I love this. Well, we'll conclude here. Again, it is recorded, so feel free to review it, to send it out to anyone that you like. And I think we'll do another webinar. We try to do them quarterly, so well, thank you everyone for joining. I'm glad we didn't have any technical difficulties like we have the last couple times, and hopefully this was helpful and valuable. And we'll see you next time.